Hi everybody, and welcome back to The Stoic Investor, your go-to channel to become a successful investor. Today, we are going to delve into one of the most controversial topics in the investing industry. Timing the market or timing the market? Which one is better, and which one you should adopt in order to grow your wealth consistently? Stick around till the end, because by the end of this video, you will have all the answer you need and the strategy that you can deploy in order to grow your return over time. So let's start by defining what these two terms mean. On one side, we have time in the market, which refers to how long you stay invested in the market. It's about having the money working for you throughout the ups and downs in the market. On the other side, we have timing the market, which is the attempt to try to predict those ups and downs and therefore deciding when to buy or sell the stock depending on those predictions. So ultimately, what you would like to achieve when trying to timing the market is to buy low and to sell high. It is very easy to see why people are so tempted about timing the market. Who wouldn't want to enter the market just before a recovery or the day before a market crash? However, here is the catch. Very few selected investors can do that consistently and successfully. Have you ever wondered why market experts on TV make so many predictions every day? And they seem also very happy about that. The hard truth is that no one can predict the future, and especially the markets. However, still people fall prey of this illusion of control because this is what they want to hear, and this is how they get reassured. A study by Schroders some years ago revealed that the vast majority of professional investors do not manage to beat the market. So, if they can't, which are the chances that are left for retail investors? One of the biggest risks in trying to time the market is missing out on the best days. Let me give you some data. Howard Marks, in his letter to Oaktree clients in 1993, wrote that the average annual return on equities between 1927 and 1986 was about 9.4%. However, if an investor would have gone cash in order to try to avoid the market crashes and missed just 50 out of the 750 months approximately, he would have missed completely the entire return. This for me means that trying to time the market is not a way to protect your wealth, but rather an additional source of risk. During market turbulence, you often hear market experts saying that there is a lot of uncertainty in the market, that there is enhanced volatility, that it's better to wait for an improvement in the liquidity condition or in the political landscape. Let me tell you this. This type of advice are the most dangerous and expensive for an investor. This is because the excess of return in the market does not happen linearly, but is usually concentrated in a very short time period, in very few days, where there is a spike in volatility and the stock prices start to skyrocket. So if an investor is out during those days, he stands very good chances to miss out completely the entire return. Apple, from its IPO in 1980 till now, delivered approximately 225x, meaning that if at the IPO you would have invested $10,000, now you would probably end up with 2.25 million. Easy, right? Let me tell you this. Do you think you could have stomached an 85% drop? Or several instances when Apple prices fall more than 40%? Think about that when you think that there are free lunches in the market. And now let's talk about time in the market. If you follow this channel, you might have heard me saying that the most powerful force in investing is the compound interest. The longer your money stays invested, and the more time you give it to grow for you and to work for you. And it's not only about the price appreciation, but it's also about compounding the dividends and having earnings building on earnings. It's like when you plant a tree. The earlier you plant the tree, and the more time you give it to grow. For sure, there is the weather that you cannot predict. There might be wind, there might be thunderstorm. But if you give it enough time and you leave the plant alone, it will grow stronger and stronger. Peter Lynch said once that regardless of the methods that you decide to pick up stocks, your success as an investor depends solely on your ability to ignore the outside world and to hold onto your winning stocks. If we look at historical data, the markets have always trended upwards. For sure, there have been recession, collapses, market crashes, bear market, but the market has always managed to recover. So the point is that if you stay invested in the market, you are just maximizing your chances to achieve great return. Think about that. Improvements in the mankind are long-term. They are achieved step by step, and they took several years. Despite all challenges, humans have always managed to progress. However, in the media, you rather hear about exceptional things rather than common ones. This is because improvements take time, they happen slowly, and they are very fragmented compared to the pace at which the news have to circulate and media have to sell. This is why in the media, you always will hear about political instability, tragedy, natural disaster, recession, and bear market, rather than the improvement and the step-by-step progresses that happen every day. So what can be an initial strategy to have a time in the market approach? Well, first of all, the dollar cost average, which basically implies that you decide a fixed amount of money that you invest every month. For sure, sometimes you will buy high, other times you will buy low, but you will stay invested in the market throughout the different cycles. And because we said that the market has always trended upward, you will make sure in this way to maximize your return. Another important point is diversification. You want to be diversified across different asset classes and also with different strategies. This in particular if you are a retail investor. And finally, you need to stay the course. You need to ignore the short-term volatility. You need to ignore the television, Bloomberg, CNBC, and especially the market gurus in YouTube. Look, I get it. The temptation to try to time the market is very strong. However, history and data are very clear. Time in the market has always beat time in the market. This is because there is one very fundamental truth in the market. That is that it does whatever it wants and when it wants. And trying to predict when and what the market is going to do can only lead you to disastrous results. Therefore, a better thing to do is to stay humble and to focus on what you can control. Your investment process, the research, the time that you spend analyzing the business. Because you need to have clear in your mind that investing is a long-term game. Therefore, it's much better to stay focused, to stay humble, to stay patient, and to ignore the short-term volatility. If you found value in this video, please don't forget to give it a thumbs up, subscribe to the channel, and ping the notification bell. Also, you might want to consider sharing it with your friends or with whoever you think might be interested. Thanks for watching, and cheers. See you next time.